What's up, everybody? Aaron Smith here with the Real Estate Momentum Podcast, and today is a solo show. We're going to be talking about what's going on in the real estate market right now so that you can make decisions and know what's actually happening. But first, if you've watched my show or if this is your first time, feel free to go into our YouTube and subscribe, and go ahead and go to Apple Podcast or Spotify and subscribe to the podcast, because we love getting feedback and reviews from people on what they want to know more about. So go in there and subscribe to those. I would be forever grateful. Thank you. So today we're talking about clickbait and what is the messaging that I'm seeing put out there right now from loan officers and real estate agents to keep buyers and sellers engaged in what's going on out there and give them hope, which it's all good. I mean, sharing a message is great as long as it's accurate and it's not this bait and switch kind of thing. I've talked to no fewer than 4 loan officers. I just got off the phone with one here, very prominent loan officer in Northern Kentucky, about some of these clickbait lending things, right? And it's not that they're not useful. These are all tools that fit in the tool belt of a real estate agent, mortgage loan officer, as things that we could offer to our clients that fit their situation. But there's a lot of myths out there about these products, and there's a lot of uncertainty about the products. So hopefully I can shed a little light on what's going on. I'm not a mortgage loan officer. I'm not a financial advisor, but I do want to open up the concept so that you can see what these topics look like. So, topic that I've seen a lot about, there's 3 of them here. Okay, so number one of the topics that we've heard a lot about lately that people want to know more about is loan assumptions. I can take over your loan because you've got a 3% interest rate. That sounds pretty darn enticing. So what does it take to enter into an assumable loan? Well, first of all, there are 3 types of financing that you might enter into an assumable loan on. Number 1 is going to be your FHA loan, Federal Housing Administration. Number 2 is going to be USDA, or United States Department of Agriculture. That's a rural housing loan. And then number 3 is a VA loan. All 3 loans are backed by the government. VA loans are only for veterans or people who have a DD-214, which is your veteran benefits, your VA benefits that you can use your VA loan with. All of these loans are backed by the government, and they all have different criteria that need to be met. One fact is that if you hear about an assumable loan, it's going to probably need to be one of these 3 loans, okay? The other thing is that you can't just go to any loan officer. If my friend says, hey, I want to sell this house on an assumable loan, I can't just go to any loan officer and get pre-approved to take over their mortgage. I've got to go through whoever is servicing their mortgage currently. So if their loan is through Wells Fargo, and if it's an FHA loan, I'm going to have to go to Wells Fargo and talk to their loan servicing department, and I'm going to have to get qualified to take over that loan. When I say qualified, your debt to income has to check out. Your credit score has to check out, and basically you have to meet all the criteria to take over the loan. The other problem that comes into play here is, let's say that my friend or whoever the seller is on this house and I'm about to take over the loan on, let's say that they bought it for the sake of round numbers, $200,000, and it's worth, say, $250,000 today. Well, let's say that they still owe $189,000 on it, but it's got a sweet 3% interest rate. Well, if they still owe $190,000 on this house, thereabouts, and they want to sell it for $250,000, well, we've got ourselves a $60,000 gap. And I can either assume their loan at $190,000 and then bring $60,000 as my down payment, or I would have to get a second mortgage, and in which case I believe the loan that you're assuming would have to be okay with you getting a second loan on this thing. You'd have to go through some hoops to get this done. If you're a conventional buyer and you're planning on putting down a significant amount of money, could be a good situation for you. On a VA loan, you have to be a veteran to assume a VA loan. And you have to have the ability, you have to have enough eligibility to purchase that. And you also have to meet debt to income and credit standards. So these are, when I say it's kind of like a perfect storm for a loan assumption, the truth is that you've got to have a buyer and a seller who are able to find each other. some way, somehow. You've got to have the right house for the buyer. The buyer's not just going to buy a house just because the loan's there to be picked up. And you've got to have the proper debt to income ratio. You've got to have the down payment. So all of these pieces of the puzzle have to come together for a loan assumption. Are they possible? Absolutely. Is it likely that you're going to find all the pieces of the puzzle that match up at the right time? Probability is low. So assumable loans, they're out there. You can pick up somebody else's loan with a really low interest rate on it. You just got to make sure that you get all the ingredients put together at the same time. So that was number one. Number two, the other thing that we're hearing about right now is rate buy downs. And what builders are doing right now is they're buying down home buyers' rates as an incentive. Builders have the ability to do this because they've got a little bit deeper pockets. They control the price of the house. So essentially they're saying, in order to protect the values of this community that we just built, we're going to keep the prices high. But in order to make it worth your while to buy this house, we're actually going to pay our lender a certain amount of money to buy your interest rate down to a palatable payment for you. Most retail sellers can't do that. If I'm selling my house, well, you're going to pay whatever the comps are for my house. I'm not a builder. I don't create my own comps. So you're going to pay whatever my comps are for my house. And quite frankly, I don't have tens of thousands of dollars to go buying down your interest rate for 30 years. So builders do have an advantage there. However, retail sellers can offer rate buy downs. There's something called a 2-1 buy down. So what that means is if you get your house in 2022, for the first year, let's say that the actual mortgage rate right now for a 30-year fixed is 7.125%. A 2-1 buy down would mean for the first year, between November 2022 and November 2023, your rate is going to be 2 percentage points cheaper. So you'll be at 5.125. On the second year, your rate is going to be 1% cheaper than the initial rate. So you'd be at 6.25% or 6.125%. Year 3 through 30 is going to be at that 7.125%. So when you talk to a loan officer and you hear 2-1 buy down and you're wanting to make an offer where the seller buys down your rate, if it's a 2-1 buy down, they're going to buy your rate down for year 1 and year 2. There are buy downs that you can buy down the rate for the entire 30 years or 15 years that you finance the home. It is relatively expensive because whoever's buying down the rate is essentially paying the interest rate up front so that the buyer can have a cheaper mortgage payment. The bank's going to get their money one way or the other. It just might make more sense that if your monthly cash flow is a little tighter, you might want that rate to be a little lower for the first year or two. If you're going to be in that house for a long time, getting a longer period of rate buy down might be more advantageous than just saving in the first year or two. But on a $500,000 house or $400,000 house, the chances are on a 2-1 buy down right now, you'd probably save about $9,500. If you have a specific scenario or a specific situation, we can talk to a loan officer on the phone and get a clearer picture of what that would look like for you. Last but not least, adjustable rate mortgages. These things are talked about like a backpack left in an airport. Like people are like, oh my gosh, it's an adjustable rate mortgage. That's a dangerous thing. It's like, okay, well, so is a hammer if you don't use it properly, right? It's a tool in the toolbox. An adjustable rate mortgage means that on day one of this loan, you are locked in for a period of time for a cheaper mortgage rate than what you could get a 30-year fixed rate mortgage for. Let's break it down, right? So there are 3, 5, 7, 10, and 15-year adjustable rate mortgages based on the lender that I talked to this morning. Let's say that today's rate is 7.125% interest on a 30-year fixed mortgage. If you're looking at an adjustable rate, let's just look at a 5-1 ARM, right? So what does that mean? Adjustable rate mortgage, 5-1 ARM. What that means is for the first 5 years of you owning that house or owning that mortgage, for the first 5 years, you're going to get a set rate. It will not adjust for the first 5 years. Right now, let's say that your interest rate is 7 or 7 1/8. Right now, a 5-1 ARM, you're probably getting in that 5 to 5.5 range, saving 1.5 to 2 points on your mortgage for the first 5 years. That's the 5-year part. That 5-1 ARM, you're locked in for 5 years. After that 5 years, your rate can adjust one time per year. And usually there's a cap on what it can adjust per year. I think right now, based on the lender I talked to this morning, he gave an example of a 2% hike per year with a total cap of 6% raise. So what that means is first 5 years, your rate is 5%. Year number 6, rates are through the roof. The most your rate can go up to is a 7. Year number 7, it can go up another 2% at the most. And then after that, it can go up another 2% for a total cap of a 6% raise. Then you're paying around 11% interest on your loan. The goal is, when you get an adjustable rate mortgage, the goal is either sell the house or refinance before you get into a situation where you're paying a lot more money. So what some people are doing right now when they're talking about these adjustable rate mortgages, you've probably seen a post or you've heard somebody say, marry the house and date the rate. Essentially what they're doing is they're rolling the dice. They're getting an adjustable rate mortgage locked in for the first 5 years and hoping that sometime over those 5 years or 7 or 10 or however many years you get the adjustable rate lock for, you're hoping that during that initial lock period that you run across a mortgage rate that's cheaper that you can refinance on long term if you're going to stay there for a while. If I'm a first-time home buyer, I'm looking at a 7 or a 10-year adjustable rate mortgage right now because I can get into it a lot cheaper than I can a 30-year fixed. And there's a good chance that I'm not going to be in that house 7 or 10 years from now. I'm going to buy the house. I'm going to get a raise at my job. I'm going to maybe have dual income after a while. I might grow out of the house by 7 to 10 years. So I'm looking to get a cheap enough rate so that I can pay as little as possible on this thing for the time that I'm there, build up some equity in the house, let it appreciate over time. I'm going to sell out before I have to raise the interest rate on an adjustable rate mortgage. So again, this is not like, when you hear adjustable rate, a lot of people are fearful because when there were piss poor mortgage practices that happened back in 2008 and prior, a lot of the fingers got pointed at people taking on these adjustable rate mortgages, and when the rate adjusted, they couldn't do anything about it. They ended up losing the house. Yes, those situations did happen. There were bad mortgage tactics that happened back then. And when rates have recent history have been between 2.5% and 4% over the last few years, yes, an adjustable rate mortgage is going to sound like a terrible thing because there's only one direction that mortgage is going to adjust, and that's up. But right now, we're in uncertain times. And if you're in a situation where you're in a home ownership for probably going to be there for 3 to 5, maybe 7 years, but there's a good chance, good probability that you're going to end up moving after that, adjustable rate mortgage might be something you want to ask about because it's another tool in the tool belt. And if you are in the market to buy a house, knowing what options are out there for you is better than not knowing, and then you wish you had known about it because you could have saved a few $1,000s a year. So today's conversation was about finances and what stories are behind these finances as you're hearing these social media posts, or if you're hearing somebody who used to be in mortgage talk about what you should be doing right now. These are 3 of the very many mortgage practices that are out there right now, and they're being talked about a lot. That's your loan assumption. This is your rate buy down, like a 2-1 buy down or a rate buy down, and the adjustable rate mortgage. So when you hear these things, you have questions, feel free to reach out to me. I'll put you in touch with one of my trusted loan officers, or maybe I can answer your question directly. There's a lot of options out there for financing right now. These are just 3 that have probably the biggest myth understandings around them. So thanks for tuning in. Don't forget to subscribe to our YouTube channel. Check out our podcast on Spotify and Apple Podcast. I so appreciate you for listening. Stay tuned for more.